Shall we get started? All right, let's do it. Look, today's lecture, we're basically going to start and do like a material percentage of topic 2 in the course. So I just kind of like, you'll notice, for instance, homework 1 of this course combines both topic 1 and topic 2. It's because I really think of those two topics as capturing the qualitative essence of this course, okay? And if we want to just kind of hark back a little bit to what we've done in topic 1, which actually I'm spending much more time on topic 1 than on topic 2. Topic 1 was really about getting you guys to, I think, understand the life experience of a startup, right? And there's a specific reason why I wanted you guys to have a good understanding of what the main challenges and the main kind of strategies that startups use to navigate those challenges are in practice. And it's something that has value for you, regardless of whether you think you'll be on the investor side or whether you think you'll be on the startup / founder side, right? I think it's pretty obvious that you want to know this life cycle if you're going to be a startup founder. I don't think it takes a genius to realize that that probably makes sense, right? But the investor side is also quite important. And it's quite important for a couple of reasons. Like understanding what the life cycle of a startup is going to look like allows you to figure out what you want to be looking at and how you want to be defining success for the startup over intermediate stages, right? Look, yes, of course, if I'm a VC and I invest in a startup in the early stage, yeah, ultimately success is, do you have a big exit? Fine, we can all agree with that, right? But the thing is, the amount of time between invest in an early stage startup and exit for even a successful company like a Dropbox or a Facebook, so on and so forth, like that gap in time is measured in many years, right? 5, 10, and even more than 10 years at this stage, right? So that ultimate success doesn't really help us for benchmarking early on. And we know that we're going to need to benchmark because we're going to have to decide, do we want to fund them again? Do we want to fund them again because of the staggered financing? So understanding the life cycle of startups as an investor helps you make better decisions in the future on the companies you've already invested in or that have already been invested in, because you can start to ask, what should this company have achieved given the reality of the challenges they face, right? So it's helpful for making better investment decisions, but there's also another reason as an investor that this is helpful. Because if you really understand the challenges that a startup faces, you're in a better position to help the startup, right? Because, a lot of startup founders don't really know, right? If you're a startup founder and you just dropped out of McGill after you won, that's what, sophomore year? So like, come on, you don't know everything, right? And there's probably a lot of things where you underestimate the difficulties that you're going to face, right? Just, we had, for instance, mentioned that a lot of engineering founders usually, right, technical founders, oftentimes underestimate how difficult search for go-to-market fit is, right? And so if founders don't really know, they could use the help. And that's one of the things that investors can do to add value to the startup. And that can be very valuable for an investor, because if an investor is respected in terms of the advice and the support that they give, then more founders are going to want to raise money from that investor, right? VC is a pretty competitive field, right? It's competitive for you to get into VC. It's also competitive among VCs to get the best startups to accept their money instead of the other 5 companies that are willing to fund them. And one point of differentiation that can help you in that competition is that you really understand what it is to be a startup, and you put resources around you and competencies around you, including your own knowledge, that can help, right? If you can do a better job adding value than everyone else, well, guess what? You can use that to your negotiation advantage by asking for a little bit more equity because you're justifying it by adding value. And there is evidence that startups, if they have a financial offer from a prestigious venture firm versus a financial offer from a less well-known venture firm, they'll accept the more prestigious venture offer, even if it offers them worse financial terms. So there's been some empirical research by nerdy academics that that has looked at that stuff, for instance. Right? So actually knowing that stuff, even if it doesn't feel like finance per se, is like first order important when you're doing finance in the early stage like this. Super important. So to me, that's a justification, even if you're only taking this course because you're interested in becoming a VC investor, that you should still be highly motivated to be able to think like a founder and to think about what a founder needs, because it'll help you, what we call securing deal flow or sourcing deals, right? You'll have a chance to invest in the best stuff. Because trust me, like once things look good for a Facebook or once things look good for an Airbnb, everyone wants to invest in them. So like, you need to figure out a way to make yourself look like the attractive investor, right? And I think understanding that life cycle is very important. I mean, in some sense, consistent with that, that's why we see VCs produce so much blog content, try to establish thought leadership through podcasts, sometimes even through their Twitter feed, or show up in all sorts of interviews when you go and search stuff on YouTube, for instance. Right? The reason why all that content exists is because all those folks who are producing that content, they're basically trying to signal to founders, I know my shit, right? So the fact that they put so much effort into that should tell you that you should probably put in some effort into that if you want to be in VC. Like that seems pretty transparently obvious to me, right? And so that's why we spent actually a fair amount of time talking about the life cycle startups and spent way more time talking about it than you would probably see in almost any other VC course. I just think other VC courses have it wrong. And part of the reason I got that opinion is because I surveyed a lot of practitioners and they said that you need to focus on this, right? So this is that's not coming from me. And I'm just kind of stealing the idea from people who actually know better than me. Now, we also see when we're talking about the life cycle startup, just how important thinking qualitatively and in a very broad and multidisciplinary manner it is when you're kind of navigating these early stages of a startup, right? It's not a purely strategy thing. It's not a purely sales and marketing thing. It's not a purely finance thing. It's basically, I mean, first and foremost, or early on, it's a mostly experimental thing, but that borrows elements from all of these fields, right? And oftentimes, because there's so few people at the organization, one person needs to be able to put many hats on, right? But hopefully one of the things that emerged from that topic is just how important the qualitative loading is in doing this stuff on planet Earth, right? And so I want to continue on that theme today, and probably our next lecture, at least part of it as well, by talking more about qualitative aspects related to decision-making in the startup ecosystem, but really today I'm going to be talking about it in terms of decision-making where we're trying to decide, is an investment opportunity, promising or not. And again, this is still like, I guess when I say is an investment opportunity promising or not, like the first thing we think about now is, okay, this is about the investor, because the investor needs to ask themselves that question when a startup pitches to them. But the flip side is like the startup needs to think about this as well, because they need to think about how they're going to make their pitch to make themselves look appealing to the VC. And they also need to think, is this a good idea before they go and like spend a year of their life building, an MVP and doing a bunch of stuff before they even ever go and raise money, right? So I'm going to be talking about this mostly from an investor perspective, right? But just keep in mind that, as a founder, you're interested in the investor perspective because that guides what you do. So that as a founder, if you can't think like an investor, right, some of your actions are not going to be properly calibrated to success. Sound good? So that's what we're going to start today. And the first things we're going to do, let me just start sharing my slides. This is a frame. everyone can see, everyone knows what a frame is. Sorry, I just had some windows pop up. We're going to be talking about frameworks. Okay, so just to give you a sense of what we're going to be doing holistically in this topic, we're going to introduce two frameworks for qualitatively assessing investment opportunities. One framework is going to be focused on the project, on the startup, on the idea. Okay, and it's really going to be a list of questions that are relevant to ask yourself when you're trying to qualitatively assess whether a project is promising. But project isn't the only thing that matters. And this is especially true early on with a startup, which is that the people matter as well. So we also want a framework for qualitatively assessing the people in a startup, most notably focused on the founders or the founding team. Again, a set of questions that I think are relevant to ask when we're trying to size up founders. So we're going to discuss those two frameworks, right? And the videos that I had you guys look at, some of them at least, were really about looking at that. So for instance, the Jim Guts thing, for instance, the Peter Fenton video. Peter Fenton was about assessing founders. Jim Guts, that some of you may have had difficulty getting to the right video, is laying out some ideas around what they look for in a project, as opposed to just people, right? But what we're going to see with both of the frameworks that I give you guys is it's a long list of questions, right? And with a list of questions, I was trying to be fairly comprehensive, but you don't want to view the frameworks as a checklist. So when you're using a framework, if let's say there's 10 questions that you want to ask, your decision to invest in something should not be, I will only invest if this is an A+ on all 10 questions, right? Not a checklist. Few reasons for that. One is, if you wait until something looks amazing in every dimension, you will wait a long time. You may wait forever, which is not very good, right? If I told you, yeah, be a VC, this is a checklist. By the way, it'll lead to you never investing once in your life. That would not look like a very good way to go about building a career, right? So it's not a checklist, because then you would invest in so little. The other thing is, if something is an A+ on everything in the checklist, trust me, that's not a secret that only you know. Like, everyone's going to feel good about this thing. And if everyone feels good about this thing, guess what? You're going to go into a bidding war, right? And what happens to your potential returns in a bidding war? Bidding war, price goes up, expected returns go down. You're not going to hit a home run if you put yourself in an intense bidding war where every single potential investor, thinks, wow, this is the best thing since sliced bread, right? You need to be a bit contrarian with your investments. And so what that means is you need to be a little bit more clever with your frameworks. It's not about something looking good everywhere. You need to kind of decide, like, what is okay to look bad and what is so important that it look good. And by the way, so it becomes about both weighing the checklist inside the framework. It's also about weighing the two different frameworks. Like, do you prefer having a kind of shitty sounding project with like a truly amazing team, or vice versa, right? It's about weighing the frameworks. And so that's another question we're going to ask. We're going to try to get some snippets of insights on how people think about weighing those frameworks. But let me be absolutely clear. When I talk about weighing frameworks here, I'm not going to give you this like magic formula on like how you always weigh frameworks. I mean, literally, if I knew that, I would not be teaching you right now, to be honest, right? It's really, really difficult. And by the way, even professional VCs, even the most famous ones, get it really wrong sometimes. But it is useful to be mindful, right? You want to think about, well, what in this framework do I really need for this type of project or for this type of founding team that it really looked tight? And what kind of weaknesses are acceptable? We want to train our minds to ask that question and to try to answer it. I mean, is maybe the more humble way to talk about what people in the real world try to do, right? And let's remember, right? There's this idea of being, you want to use these frameworks in a way that helps you be contrarian, so that you're disregarding weaknesses that other people also see, but that you think are not that important, and where your opportunity has strengths that maybe you think are supremely important, but others aren't quite aware of that importance, right? That's what allows you to be right, but also contrarian, right? And being contrarian and right is the holy grail of making investments in VC that succeed, because those are the ones where there isn't a bidding war at the beginning, but if things work out well, home run. And if you recall, at the beginning of the semester, I posted a video where I do talk about the unique distribution of returns for startups, and the idea that home runs are what drive returns in VC. In other words, if you're not making the contrarian and right bets, you are not going to be a successful venture fund if we look at the historical data. The only way to win is to be hitting home runs sometimes. So that it is so, so important to think about how you can be contrarian and right. And so there's different strategies to being. So here's the thing. Here's the tricky thing. It's like a lot easier to be contrarian and wrong than contrarian and right. Because like on average, people like the crowd is right? You need to find those special instances when the crowd just missed something systematic, right? And so the question is, what can you do? Because most of the time when people are contrarian, they end up being wrong. And what you want to do is you want to shift the probability that you become contrarian and right a little bit in your favor, right? So that like when you go against the crowd, most human beings, when they go against the crowd, would be right 1% of the time, and you want to be right 5% of the time. That's kind of like what you want to do. And so the question is, what sort of things can you do to up the likelihood that you're contrarian and right? Well, one really good strategy is to try to forecast future opportunities. Because if you've got an opportunity that's looming, and what I mean by that, it's looming in the sense that other people are going to catch up to the program and understand that it's promising in a little bit in the future. If you're able to figure that out before them, a year before them, 2 years before them, right? So if you're better at forecasting future opportunities than other people, then that can allow you to be contrarian and right. Because you'll be making the bets a little bit before everyone else does. And so while you're making the bets, there's no bidding wars. But then later on, once people figure out like, oh, wow, there was some justification to that investment thesis, right? Then all of a sudden, it'll actually be even better for you, because then like valuations are going to start popping up for the stuff you just invested in pretty quickly, right? And that's what we're going to do in the fourth section of this topic, is that we're going to talk about some tried and true strategies that VCs use to try to forecast future opportunities. This last section, we're definitely not going to cover today. It's an open question on whether we'll talk about weighing frameworks. It depends on my stamina level. Okay, I've been actually lecturing this I've already lectured 5 hours today. So, sound good? Let's go ahead and do that.